Hi there, this is Alvin from Dr. Wealth, and in the past videos I've seen the comments. Some of you have been asking for a commentary on the China stock market, so this video is dedicated to answer that question. Okay, so we all know that the China stock market has not been doing well, and even for this year that US market has gone up. S&P 500 almost gained 20% year to date, and yet the China stock market as measured by the MSCI China is actually down by about 17%. So that is something that investors have always been scratching their head. Why is this going on? Is it really that bad? That's what's going on in China, and is China's stocks ever going to recover? So I guess a lot of China investors who have still have the China stock holdings would be having this doubt. Should they cut their losses? Should they sell the stocks and move on, right? Especially if the US stocks is doing well. But at the same time, people are afraid that once they sell it, the market start to recover, and when they buy the US stocks, and if there's a correction or recession that's coming, it might be a bad move, right? So of course, we won't know the future, but I wanted to give you my take about what's going on in China, and so hopefully by the end of the video, you will be able to make a more informed decision. Okay, so I wanted to also talk about the performance or the underperformance of the China stock market, not just in 2023, but if you take a look at 2022, 2021, it has been down 20% for each year. Okay, and coupled with another 17% down this year, right? That is really quite a painful compounding of losses in these 3 years. So it has not been an easy time for China investors, and people were of course wondering whether 2024 will be a better year, right? And the way I see it is like 3 years is usually quite an anomaly. Okay, especially if you benchmark against like the US stocks, very seldom they have 3 consecutive years of losses for the indices. Okay, so but somehow the China stocks have been really beaten down very badly, and I want to give you the reason. Okay, and with that you might see overseas or foreign investing very differently, as in ex-US investments, right? Especially in Asia, this would probably be a very important criteria for you to consider, not just the fundamentals of the businesses in Asia. Okay, so the way that I see the issue with these China stocks being underperforming is because of fund flows. Okay, so that is the crucial difference between what is happening in Asia, especially in China, right? Because foreign investors have been selling these China stocks, and it resulted in this very lackluster performance. And in 2021, the foreign holdings of China stocks bonds have peaked. Okay, it has been coming down since, right? So that coincides with the poor performance of MSCI China, right? If you recall, 2021 was a down year, starting from 2021, then 2022, and carry on to 2023. So you can see that these foreign investors have been selling China stocks or even bonds since 2021, and this exodus it cannot be replaced, right? Cannot be replaced by the local investors. And also, again, I want to give you the reason why. All right, if we go and take a look at the world's largest fund managers, right, be it hedge fund, mutual funds, let me blow this up for you, right? These are the top 10. You can see 9 out of 10 comes from North America. Okay, and then number 10, Allianz, is from Europe. And we can also see that these top fund managers, right, would unlikely invest in China given the political tension that's going on, and there might be even some political motive, right, to persuade these fund managers not to invest in China, in fact to sell China, to move the funds back to US, right? And it can also be a pressure by investors in their funds, right? Because they may feel that the investors themselves, the retail investors, might be selling the fund, right? Any China fund. So no choice, this asset manager also have to sell the China holdings at the end of the day. So having this largest fund managers residing in US is not a good thing for China, because that means that China has very little say where the fund flows is going, and the geopolitical tension definitely does not end well for China. The money just exited a lot of these China investments altogether, and I wanted to find, right, where is the largest China fund. Okay, and if we look through the list, I found that the largest fund manager that is located in China is China Life Insurance. Okay, so and is ranked 63rd, and majority of the managers in the top 50 is based in US, right, in North America, with a total asset under management of in the tune of $76 billion. So it is true that the US control the fund flows. The US decides where the investment dollars go to. Okay, so with that, if they're not happy with China, they will stop investing in China. In fact, they will sell down China. And with that kind of massive selling, there isn't another fund that is in China that can replace this exodus of US funds, right? As we can see, the largest fund manager from China is ranked 63rd. How are you going to have enough bullets to fight the top 50 if they are exiting, okay? And if we just look broader as Asia, right, there are only one that is in the top 50, and that is Mitsubishi UFJ Trust and Banking Corporation, and that is ranked. Okay, I didn't have it here, but it's within the top 50. That's the only Asian fund, and even Japan is not in good terms with China. So why would Japan invest in China as well? Okay, so you can see that it is definitely not a very good sign for China stocks altogether, because the US control China's stock market actually. Okay, so that's pretty scary. And if we take a look at, what if, we talk about China is a big market, we have a lot of people over there, the population is huge, 1.4 billion people. What if they are the ones that invest in the stocks and give support to their own stock market? Unfortunately, that is not the case, okay? This is the OECD data, which is the percentage of household financial assets that is denominated in stocks, okay? Just household assets in financial assets, okay, just household financial assets, not the total assets, not including, say, properties and things like that. Okay, just in financial assets, can be bonds, can be unit trusts, etc. Okay, so this is a subset of a subset. So if you take a look, US has about 39% of their financial assets in stocks, right? That's quite a high percentage. And if we look at even in Europe, France at 24%, Germany at 11%, and in Asia is relatively lower as well. Korea at 17.8%, Japan at 12%. So these are very small numbers, which just shows us that investors outside of the US don't really buy stocks. Okay, especially in Asia, we know people in Asia love properties, right? So they spend more, they invest most of their assets in the form of property assets, okay, instead of stocks. And that is again not a very good sign, right? I only have these countries. I pick up a few of this, a handful of them. They don't have China, unfortunately, but we can gather some data from elsewhere, right? So back home in Singapore, this is also quite representative, I believe, of typical Asian kind of household asset allocation. So we can see that 44% in properties, right? 18% in CPF, equivalent pension funds, 20% in savings, right? Cash savings, 9% in life insurance, only a mere 4% is invested in listed stocks. And I give you another segment, which is unit trust and investment fund, another 4%, add together 8%, okay? But this is based on the total asset breakdown, right? Not just the financial asset itself. You can see that, again, majority of the assets are based in more principal guaranteed or very stable assets like properties, right, that don't fluctuate too much in terms of their value. We can see cash doesn't grow very fast because interest rate is not high on savings deposits, and CPF is principal guaranteed, and OA is like 2.5%, SA is like 4%. It's not equity-like kind of investment returns. So very conservative, right? Typical Asian kind of asset allocations as such. And if we look at China, and I found this another chart that we can make comparison with, right? So China is the rightmost column, and just compare China and US, I think that's more than enough. You can see that properties represented majority of the China household asset allocation. Granted, this is based in 2019, but I doubt it has ever changed 4 years from then. Okay, and for US, it's just slightly above 20%. And the stock allocation is also much higher than, more than double of what a typical China household invest in. So this is why I say that it is not possible to replace the exodus of US funds from China stock market. Okay, the retail investors are not buying the stocks, and generally the institutions are not large enough, right? As we can see, the top 50 fund managers, none of them are from China, so there isn't a counterbalance to the exit. And this is another sign to show you that it's very unlikely that the retail investors in China is going back to the stock market. Why? given that the property market has crashed, right, and you can see that majority of the assets of the Chinese household is in properties, and that is naturally that they feel a lot poorer, right? If the market is down, their property valuation is down, definitely they will feel a very big impact to their net worth, even though they will still have the roof over their head, right? But the Chinese are a pessimistic bunch, right? They always believe that you must save for a rainy day, you must save for a rainy day, and hence after COVID, you can see that the saving rate or the household savings to income ratio just went up, right? They used to save about 30% pre-COVID, and after COVID, they're saving like 35% of their income, so increased by 5%. Compared to before COVID period. And with the youth unemployment, right, so that also create more pessimism. The people would tend to save more, right, just in case we don't have enough. So they won't be thinking of investing in the stock market. So you can see the psyche now is very different, right? So that you lose another source of capital that is coming from the retail investors in China. Is it really that bad? If we really look at the fundamentals of the Chinese economy, even though you're in the news, you keep reading about very pessimistic news about how China is slowing down, deflation is in the cards. If you take a look at the GDP growth, right, for this year, China is still expected to grow 5%. Right? That's still faster than US, and that's still faster, in fact, for the economy of that size. Okay, no other country is growing at this speed except China, and hence China remains the major driver of GDP growth for the whole world in 2023, right? 30% of the global GDP growth is coming from China. So how bad can it be, right? It is still the fastest growing economy in the world, right? No other country can contribute that share of GDP growth for the world, right? Even for US, it's only contributing 9%. So the China economy is contributing more than 3 times of this GDP growth for the whole world. So it is still a very important country, right? And in fact, the results or the economic development in 2023 it isn't that bad as what the media is portraying. And digging deeper, right, I went to look at some of the bigger companies in China and see whether they are really suffering, right? Are they still growing, or are they like really faltering, or business is real bad? If you take a look at this group of Baijiu stock, right, because the Baijiu stocks are quite large companies in China. In fact, Moutai is the second largest company after Tencent in China. So they have these 3 brands. Moutai is the biggest one, Wuliangye and Luzhou Laojiao. So these are the 3. And we can see that in the first 9 months of 2023, they can still grow their revenue, right, by the double-digit percentages, and likewise for their profits. But yet their share price has gone down. So I guarantee you, if these are US companies, right, their share price will have skyrocketed. Okay, because of the fund exodus, hence they don't care about fundamentals anymore. So this is another important lesson, right? If you want to invest in Asia, fundamentals alone just don't cut it, because highly dependent on foreign fund flows, specifically from the US investors. So if US investors is not putting money in that particular Asian country, you will never see the share price go up. Okay, as we have established, right, the insti are smaller, the retail participation is too little as well. Hence, the only difference that could cause the share price to go up in Asian stock market actually relies a lot on US investors. Okay, so unfortunately, that is the truth. Okay, we can look at more different kind of sectors and industries. So this is the e-commerce, right? So indeed, there's a bit of slowdown for Alibaba and JD, but Pinduoduo has done very well, right? Growing at 65% revenue growth, and profits are growing at 56%. Hence, you start to see Jack Ma coming out, Richard Lee coming out, talking about, yeah, we must learn from Pinduoduo, we must not slack, and we must really compete with it. So it is not exactly bad, right? This is not because of economic poor performances, but it's actually because of competition. Third, we look at household appliances. These Media, High and Gree are the 3 major brands, and even though they don't have a double-digit percentage growth, a single-digit percentage growth also shows that consumers are buying more this year compared to last year. Okay, the profits have also grown as well. So it again, it doesn't look like, when you look at this financial result, it doesn't look like China is in deflation or a slow economic growth. And travel stocks have definitely rebounded significantly due to the reopening. Right, last year China was still in lockdown. Okay, so this may be a little bit inflated and not sustainable going forward, but still a healthy rebound, a strong rebound in the travel sector also shows that consumers are spending. Okay, so it isn't as bad as what people portray. These are the sports brand, right? So single-digit revenue growth, still commendable, right? They didn't lose, they didn't decline. Okay, so I think that is still a good sign. And these are restaurants and retailers, same thing, double-digit growth. Okay, so you can see across all different sectors and the industries, the companies are actually still growing, right? Which means the GDP of China is still growing well, and also means that consumers are spending as well. Okay, so it's very contrasting. If you look at the news, especially from the Western media outlets, it's always very negative, or it's going to deflation, it's the end of China. It's almost painting a doomsday. Okay, but if you really dig the data deeper, you realize that it's not really that true. Okay, so it is not that bad, right? But because of this portrayal, a lot of the US investors may get spooked out, and they will sell down their China investments and hence accelerate that fund exodus from the China stock market. So bottom line, the US has two superpower, not in terms of military, but it has the control over the narrative or the storyline, right? Because the Western media are the most influential around the world. And if they paint a negative picture about China, most people will believe that China is doomed. Okay. And second is that we have also seen they dominate the largest funds institutions in the world, right? The top 50 majority are in US, and not just that, they control majority of the funds because their size are a lot bigger compared to even European funds or Asian funds. So when they combine these two controls together, it becomes a very powerful thing, right? Because the media will shape investors' belief about China market. When it's pessimistic, investors will sort of sell down, they move the funds out of China, and hence China stocks tank. Okay, so that is the whole picture. So this is also another way to look at things, right? How US control both the narrative as well as the fund flow. You have started to see that, you know, Japan has came out of deflation, or Japan stock market has reached 30-year high. The 3 lost decades have been recovered. And as well as India has also been burgeoning, has been doing very well this year. And you look at the stock market, Japan is up 15%, India is up 13%, while China is down 17%. So the media started to paint a positive light on China neighbor, okay, including Japan and India. And this can be seen as US plan to make India and Japan as a counterweight to the rise of China, right? Because they are in close proximity. So they are talking about US company relocating their supply chain to, say, India, right? Apple is making more products in India rather than just rely on China, and they started to invest more in Japan, right? That also includes Warren Buffett also pump in that helps in that story building, okay? And it also shows that the fund flows go to these two countries, and that helps buoy the stock market. So that's how US can shape the story and yet back up with real performance in the markets. Okay, so that is the true power of how US can control the markets. So hence, the only thing that China stock market can recover is when the US fund flows return to China stocks. Until that day happen, the China stocks, I believe it will be very difficult for them to go up, because institutions in China cannot support it. They cannot replace the equivalent size of the US funds, and the retail investors in China are not investing in their own stock market as well. So that is the picture, right? Hopefully you get a better idea and grab hold of the situation. So it really depends on what is your investment horizon, whether you can really weather this, and the issue is that we won't know, right, when or if the US funds will ever return to China. It really needs a change of narrative. It really needs the geopolitical tension to improve, right? If it worsens, then it is very unlikely that the US funds will return. So that hopefully can help you make a more informed decision of what to do with your China investment, right? Give me a thumbs up for this video, subscribe to the channel. I'll see you in the next one. Goodbye.